hit $2.35 billion. That's a fifth. If we actually analyze the deal structure, is secure and legal.
A foothold that ingredients, the raw materials used to compound these. It's so critical to sell rating. They cite the SEC probe.
Shares, to be exact, was pure.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
On March 2nd, 2026, open market insider sales for HIMS and HERS Health cleared at an average price of exactly $15.21. And if we step back, if we look at the off-exchange volume data just a few days prior to that, on February 27th, we see 9,807,371 total off-exchange shares traded. Takes a breath. Exactly 50% of that volume, 4,903,744 shares to be exact, was pure short volume. That is institutional money betting aggressively against the stock behind the scenes. And on the public side, official NYSE short interest as of mid-February reached a massive 80 million shares. That is nearly 38.89% of the tradable float. We are looking at a classic Wall Street battleground today. HIMS and HERS Health Incorporated is at a historic inflection point. The company just reported a phenomenal fiscal year 2025, generating $2.35 billion in revenue. Yet its valuation has virtually collapsed under what is being called a draconian regulatory crackdown by the FDA, the SEC, and the DOJ regarding their compounded weight loss drugs. Takes a breath. I maintain that this company is a deeply resilient, highly profitable global health platform, and its recent strategic acquisition perfectly hedges against U.S. regulatory risks, creating a historic mispricing in the market.
And I assert that the regulatory crackdown is an existential threat to the company's highest margin growth engine, and that the complex international pivot they just announced is a desperate margin-pressuring move that smart money is actively fleeing.
Let's begin by grounding this analysis in the fundamental objective strength of the enterprise. Takes a breath. It is very easy to get lost in the noise of a regulatory probe and miss the actual financial reality of fiscal year 2025. The numbers cannot be overstated. Revenue hit $2.35 billion. That's a 59% year-over-year increase, paired with $128.4 million in net income. We have to be clear here. This is no longer a cash-burning Silicon Valley startup. It is a scaled, highly profitable healthcare entity. But more importantly, I really want to emphasize the health of the core non-weight loss business.
But the weight loss business is precisely what was driving the hyper-growth premium on the stock. You can't just separate the two.
You can when you look at the subscriber metrics. Subscribers grew 12.7% to 2.5 million, and the monthly revenue per subscriber increased to $82. That increase is a direct result of highly successful cross-selling across their personalized health categories, things like dermatology, sexual health, and mental health. That foundation is incredibly sticky. It takes a breath. Now, looking to the future, we have to examine the $1.15 billion acquisition of the Australian digital health platform Eucalyptus. This is a brilliant maneuver of geographic diversification. By moving into markets like Australia, Japan, the UK, and Germany, they bypass the United States compounding issues entirely by utilizing branded, officially approved GLP-1 medications. This instantly brings over $450 million in annual recurring revenue to the table. And if you think the market uniformly hates this, look at the institutional flows. Citadel Advisors recently increased their stake by a staggering 1,158%, bringing their holdings to nearly 1.96 million shares. That's absolute proof that heavyweights see a definitive floor here.
Well, I come at it from a different way. The fundamental flaw in that perspective is the failure to properly weigh the regulatory triple threat that has fundamentally broken this company's narrative. We really have to look at what happened in early 2026. On February 5th, the company launched a compounded oral semaglutide pill at a highly disruptive price point of $49 a month. That was supposed to be the holy grail of their margin expansion. The response from federal authorities was devastatingly swift. Within 48 hours, the FDA shut it down, officially labeling the operation as illegal mass compounding.
The FDA action was aggressive, certainly, but it was a single product line suspension.
It didn't stop at a single product withdrawal, though. We are now looking at an active SEC Division of Enforcement investigation regarding their public disclosures alongside a DOJ referral from the Department of Health and Human Services. These aren't mere speed bumps. When the Department of Justice gets involved, you are looking at potential existential risk to the business model. And the immediate financial damage is already visible in the actual operations. The FDA forced them to transition their fulfillment toward tighter 503A cadences. For anyone tracking the regulatory nuance here, 503A means moving away from highly efficient bulk mass manufacturing and instead custom mixing the medication for every single individual patient. That is a logistical nightmare. It created a massive $65 million revenue headwind for the first quarter alone.
Which the company openly disclosed. They adjusted guidance to reflect that operational friction.
Yes, they issued soft Q1 guidance of $600 to $625 million, which entirely missed the $653.9 million consensus that Wall Street was modeling for. And you mentioned Citadel increasing their stake, but let's look at the broader institutional exodus. The managers who actually actively assess risk, for All on Capital sold over 7.3 million shares. That's a 68.5% reduction of their position. Renaissance Technologies cut its stake by 47%. The conviction among active, risk-aware managers is that the core growth engine is permanently impaired.
I see why you think that, but let me give you a different perspective. The weight of that regulatory risk is being grossly overestimated relative to the durability of the revenue. Yes, the SEC and DOJ probes introduce friction, and obviously they spook active managers. But the core business is structurally insulated from this specific weight loss controversy. If you isolate the United States revenue entirely outside of the contested compounding space, it still grew 16.8% to $554.1 million in the fourth quarter of 2025 alone. The underlying platform is functioning exactly as designed.
But the structural profitability is exactly what is under threat right now. Critics naturally point to the fact that their GAAP net income, the actual fully accounted bottom line profit, fell sharply to $20.6 million in Q4.
We have to contextualize that drop, though. That wasn't due to structural decay, and it certainly wasn't from regulatory fines. It was a conscious, strategic capital allocation toward marketing. They ran a massive, high-profile Super Bowl ad. Takes a breath. They also absorbed the launch expenses for new, highly profitable specialties like testosterone therapy. The structural profitability of those 2.5 million subscribers paying $82 a month is completely intact.
Right, I don't dispute the stickiness of a dermatology subscriber, but the path to massive profitability was paved by the $49 weight loss pill, which has effectively been removed from the board. The SEC and DOJ probes are profoundly non-trivial. They carry massive potential financial liabilities if it's determined that investors were intentionally misled about the sustainability of the compounding model. And we don't have to guess how the internal leadership views this legal risk. On March 2nd, the chief legal officer, Soleil Martin, sold 4,651 shares at the deeply depressed price of $15.21.
That was an automated sale. It was executed under a pre-established 10b5-1 plan.
Yes, it was under a 10b5-1 plan. And for clarity, a 10b5-1 plan is a pre-scheduled trading mechanism designed to shield executives from insider trading accusations by setting the sale months in advance. But the execution of that sale happening at a multi-month low still reflects a grim internal reality. If leadership believed the regulatory overhang was a brief misunderstanding, they could cancel or amend those plans. The weight loss engine that hit a $100 million run rate in just 7 months is severely impaired, and this looming legal overhang is suppressing any potential for the stock's multiple to expand.
That legal overhang in the U.S. is precisely why the Eucalyptus acquisition is a strategic masterstroke rather than the desperate pivot you're characterizing it as. If we actually analyze the deal structure of that $1.15 billion acquisition, it reveals an intense, calculated focus on capital preservation. Out of that total enterprise value, only $240 million is required in upfront cash. The remaining $710 million is deferred over 18 months, and $200 million is strictly tied up in performance earnouts through 2029. This structure drastically limits the immediate downside risk to HIMS and HERS balance sheet, while capturing a sprawling global consumer health ecosystem. They are aiming for $1 billion international revenue within the next few years, specifically using branded medications that completely sidestep the FDA compounding debate.
I'm sorry, but I just don't buy that. Let me tell you why. You're looking at top-line revenue, the $450 million in annual recurring revenue they just bought. But integrating an international clinical infrastructure across Australia, Japan, the UK, and Germany is incredibly expensive and operationally exhausting. You can't just bolt on $500 million in ARR across 4 different sovereign health systems and assume your profit margins will hold up.
The deferred payment structure explicitly forces Eucalyptus to perform and effectively self-fund a significant portion of its own integration.
That defers the pain, it doesn't eliminate it. Analysts at Morningstar and BTIG have explicitly warned about this exact dynamic. The high operating costs required for this massive international expansion will crush near-term margins. The company has stated a 2030 target of $6.5 billion in revenue. To hit that figure, they need to sustain an 18.3% compound annual growth rate over the next 4 years. How can they possibly achieve and sustain that trajectory when their highest margin U.S. product is bogged down in federal investigations and their free cash flow is about to be tied up in a complex, costly international integration? The math simply does not support the hypergrowth narrative anymore.
That's an interesting point, though I would frame it differently. The math of the current valuation is exactly what makes the situation so compelling for a value-oriented investor. We have a company generating substantial free cash flow, trading at a steep, punishing discount strictly due to temporary regulatory fears, while it is actively diversifying its geopolitical risk. Furthermore, the international markets they are entering with Eucalyptus already have established regulatory frameworks for branded GLP-1 weight loss drugs. The execution risk there is far lower than trying to pioneer a brand new legal framework for compounded drugs here in the United States.
But the U.S. market microstructure tells a completely different story about how the institutional world views that execution risk. Let's actually look under the hood at the dark pool data. When we say dark pool or off-exchange volume, we're talking about massive institutional trades that happen away from the public order books, the lit exchange, specifically so they don't instantly crash the broader market. When exactly 50% of the daily 9.8 million off-exchange volume is short sales, which is precisely what we saw on February 27th, and when active managers are fleeing by the millions of shares, you have to acknowledge the reality of the tape. You don't get roughly 4.9 million shares shorted off-exchange by accident. The 38.89% short interest on the lit exchange isn't a mistake either. It reflects a correct, calculated consensus that the underlying business model is fundamentally wounded. Citigroup just slashed its price target to $13.25 with a hard sell rating. They cite the SEC probe and the compounding litigation as catastrophic. The market is pricing in severe impairment because the impairment is real.
I'm not convinced by that line of reasoning because that exact market microstructure is precisely what creates the setup for a violent upward re-rating or a massive short squeeze. When you have nearly 39% of a company's tradable float shorted, the tension in the stock is immense. Any piece of good news becomes highly combustible. Let's look closely at the options market. On January 27th, we saw highly uncommon, incredibly aggressive options activity. Over 7,300 contracts traded for the $40 strike call options expiring on March 20th. Because each contract represents 100 shares, that equates to 739,200 underlying shares.
Buying out-of-the-money calls is often just a lottery ticket or a hedge against a short position.
It is, but that kind of concentrated, deeply out-of-the-money call buying suggests that sophisticated capital is positioning for a significant, immediate rebound. Takes a breath. Remember, giant passive funds like Vanguard and BlackRock have recently increased their stakes. They don't actively trade. They provide a massive, steady floor of passive demand beneath the stock. If the company announces any positive settlement with the FDA or an early benign close to the SEC probe, it will trigger an avalanche of forced buying as all those short sellers scramble to cover their positions. Simply Wall Street's quantitative fair value model places the stock at $44.36 based on its cash flows. With the structural short positioning being this extreme, That fair value isn't just some theoretical analyst target. It is highly achievable in a rapid short covering scenario.
That's a compelling argument, but have you considered that relying on a short squeeze thesis inherently ignores the fundamental deterioration that attracted the short sellers in the very first place? Shorting 39% of a mid-cap healthcare stock carries tremendous risk. Institutional short sellers do not take on that level of exposure without immense, rigorously researched conviction in the downside. The transition from bulk compounding to the much stricter, patient-specific 503A cadence is not just a temporary accounting headwind of $65 million. It fundamentally alters the unit economics of their entire weight loss offering. The incredible efficiency and margin capture they enjoyed in late 2025 cannot be replicated under the watchful, restrictive eye of the Department of Justice. Betting on a short squeeze is essentially betting that the federal government will simply back off and apologize, which is a highly speculative, frankly, dangerous thesis.
It isn't about the federal government backing off. It is about the company's ability to pivot its revenue streams faster than the regulatory friction can compress them. The non-weight loss ecosystem is incredibly robust. The subscriber growth to 2.5 million proves that the core telehealth platform continues to capture significant market share. The $82 per month in average revenue is a testament to the stickiness of the platform. Consumers trust their brand for their sensitive healthcare needs. And the Eucalyptus acquisition ensures that even if the U.S. compounding environment becomes completely untenable and they have to shutter it entirely, the company has an immediate massive foothold in international markets where the branded supply chain is secure and legal.
A foothold that, again, requires immense operational expenditure. It's so critical to separate the concept of raw revenue from the concept of profitability. Yes, they can buy $450 million in annual recurring revenue, but at what cost to the ultimate bottom line? The U.S. business was heavily subsidizing its massive marketing expenditures, like that incredibly expensive Super Bowl ad, through the incredible arbitrage of compounded semaglutide. Without that specific, highly lucrative margin profile, the path to their stated goal of reaching significant adjusted EBITDA targets by 2030 looks incredibly precarious. The fact that high-frequency trading firms and market makers are currently dominating the dark pool volume suggests that the stock is currently being treated as a high-risk volatility vehicle, not a stable, long-term growth asset.
To summarize my perspective on where we stand, the market is currently severely mispricing a company that is generating $82 per month across a highly engaged base of 2.5 million loyal subscribers. The regulatory challenges in the United States, while entirely valid to monitor and model for, are obscuring the broader fundamental reality of their cash flow. The Eucalyptus acquisition is a definitive, brilliantly structured global hedge. By securing a massive international footprint utilizing fully approved branded medications, the company effectively renders the U.S. compounding drama a temporary operational speed bump rather than a terminal event. The sheer volume of off-exchange shorting has created an artificial, sentiment-driven compression in the valuation. Any fundamental clearing of the regulatory clouds will correct this mispricing dramatically and reward the investors who looked at the actual balance sheet.
And to summarize my view, the transition away from high-margin, compounding arbitrage is far from over, and it carries profound, lasting consequences for the bottom line. It takes a breath. The SEC and DOJ overhang remains an existential threat to the frictionless growth narrative that propelled this company's valuation into the stratosphere in 2025. Furthermore, the massive international pivot, while certainly adding top-line revenue, introduces tremendous execution risk and margin pressure that they've never had to manage before. The smart money outflow we've seen from active, sophisticated managers reflects a stark reality. The risk profile has fundamentally worsened, and the structural impediments to reaching their 2030 financial targets are currently too vast to ignore.
I believe we can both acknowledge that the coming months will be entirely dictated by two critical factors. First, the actual EBITDA contribution, the true earnings power from the Eucalyptus operations once the integration begins in earnest and the deferred payments start coming due.
Absolutely. And second, any forthcoming updates regarding the FDA's green list of vetted API manufacturers.
For those listening, API stands for active pharmaceutical ingredients, the raw materials used to compound these drugs. The FDA's stance on who can legally supply those APIs will ultimately decide the long-term viability of the entire compounding model here in the United States.
Exactly. To truly understand the trajectory of this equity, one has to simultaneously evaluate the fundamental revenue durability and the complex, often opaque off-exchange market microstructure. Takes a breath. There is a profound depth to the raw 13F institutional filings, the options chain data, and the dense FDA regulatory texts that shape this landscape. The intersection of these forces will define the next chapter of this enterprise.
The data's all there for those willing to look past the surface-level volatility in the headlines. Unpacking the realities of the dark pool volume alongside the strict compliance costs of 503A fulfillment reveals the true mechanics at play. It requires a rigorous examination of both the legal filings and the market tape to fully grasp what is happening beneath the quarterly numbers.
Precisely. The numbers demand deep, continuous scrutiny, and the narrative is far from settled. Takes a breath. We leave you to weigh the evidence, examine the data, and explore the material further.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!